Hello and welcome to AE Accounting Tutorials. We are continuing our series on IAS 23, borrowing costs. In this video, we'll be looking at capitalization of borrowing costs, where we look at specific borrowing and general borrowing. We will also look at when to commence capitalization, when to suspend capitalization, and cessation provision for capitalization of borrowing costs, and probably the disclosure requirements of borrowing costs in the financial statements. Take note that in the part 1 of this video, we've already looked at the general concept of IAS 23, the scope, the objective, some basic terms, and the component of borrowing costs under IAS 23. So if you are new to this channel, I will encourage you to subscribe to this channel, turn on your notification bell so that any moment I upload any video, you will get notified on your devices. The first thing I want us to look at is capitalization of borrowing costs. When we say capitalization of borrowing cost, it simply means that the process of adding the borrowing cost to the cost of the qualifying assets and recognize it in the statement of financial position. That is what we describe as capitalization of borrowing cost. So if a construction of building is being regarded as a qualifying asset and the cost of this building is 200,000 and the borrowing cost associated with this building or this qualifying asset is 200. So when we decided to add the borrowing cost to the cost of the qualifying asset, then that process is what we call capitalization of borrowing cost. I have already explained in the part 1 of this video that before an entity will be able to raise money to finance any acquisition, production, or construction of a qualifying asset, the business has two options. Either the business will generate that fund internally or go for external borrowing. With this external borrowing, the entity may decide to go for specific borrowing or general borrowing. So under capitalization of borrowing cost, we have what we call specific borrowing and general borrowing. So we have specific borrowings and we have general borrowings. All right. So when we talk of specific borrowing is where an entity borrowed funds specifically for the production, construction, or acquisition of a particular qualifying asset. So if a business decided to borrow funds specifically for the production or construction of a qualifying asset, that fund is considered as specific borrowing. Is that okay? On the other hand, with the general borrowing, when business decided to borrow fund for several purposes, such fund is considered as general borrowing. Okay, sometimes the business may decide not to go for any general borrowing. They may have fund in their capital structure. This fund may be in the composition of the equity component and the debt component. So with this debt component, the business can decide to raise or take part of that debt component to finance a qualifying asset or construct any qualifying asset. So with these specific borrowings and general borrowings, we have way to calculate the borrowing cost under each borrowings. Is that okay? So with a specific borrowing, the first thing to do is to calculate the actual borrowing cost incurred. So after we calculate actual borrowing cost incurred, and this borrowing cost could be any of the components of borrowing cost. Where we talked about interest as one, we talk of ancillary cost, we talk about discount, we talk about premium, finance cost in relation to finance lease. All these form components of the borrowing cost. So when you borrowed money specifically to acquire or produce any qualifying assets, the borrowing cost associated with it must be calculated with respect to specific borrowing. Okay, the one thing we have to take note is that sometimes business may go in for fund to specifically to produce a qualifying asset or acquire any qualifying asset, but the acquisition or construction of the qualifying asset may take maybe 5 years. Okay, so the business can decide to go for, let's say, $100,000. So out of this 100,000, for the first 2 years, the business will only use 30,000 for the first 2 years, meaning that the remaining 70,000 will be lying down idle. Okay, reasonable business will not keep this money idle. They will decide to invest it as a temporary investment somewhere in order to generate investment income or interest to the business. Is that okay? So when the business borrowed fund and realize that part of the fund will be used for the project for some period of time and invest the remaining fund for a shorter period, which we call temporary investment, any interest or income on that investment will be subtracted from the borrowing cost incurred. So the next thing to talk about is less income on temporary investment. Is that okay? So what I'm trying to say is that when the borrowing cost incurred for the period is $1,000, then part of the fund has been invested elsewhere temporarily. So the income or the interest that the business will receive on that temporary investment is, let's say, $300. We have to subtract the $300 as an income on temporary investment from the actual borrowing cost incurred to get 700 remaining, which will be capitalized to the cost of the qualifying asset. Is that okay? That is it. So let's also look at how to determine the borrowing cost when there is a general borrowings. We've already explained the general borrowing. That is where we say that where funds are borrowed for several purposes. Is that okay? With this fund, they might not be borrowed from a single source. It might be two or more different sources. When this happens, each source, the interest and other borrowing costs, ancillary costs, and others in relation to those borrowing might be different. Okay, so we can't use a single interest rate or ancillary cost to determine the borrowing cost. It varies. Is that okay? So let's look at how we calculate the borrowing cost when there is a general borrowing where the monies are borrowed from several sources. So with this, we use what we call a capitalization rate. We use what we call capitalization rate. This simply means that when the monies are borrowed from several sources, we find the weighted average of the rate to determine the borrowing cost in relation to this. Okay, so let's say that the business decided to go in for those borrowing from 3 different banks. Okay, so let's say Agricultural Development Bank and United Bank for Africa. Then we have Ghana Commercial Bank. So the loan amount here, so let's say loan, and let's say the interest rate. So the loan amount is 8,000 at 5%. Let's say 15,000 at 6%. Let's say 7,000 at, let's say, 2%. It means that the interest rates are different. So in order to calculate the capitalization rate, we find the weighted average of this rate. Okay, in order to find the weighted average, we calculate the interest on each. So this will be 400, 900, and 140. So we find the total of this. This is 30,000, and this is 1,440 as the total interest. So in order to calculate or determine the capitalization rate, the general principle is that we divide the total interest by that of the total loan. Is that okay? So we have what we call capitalization rate is interest over loan. That is total interest over total loan, where we have the interest to be 1,440 divided by the 30,000 Is that okay? Because we want the rate in percentage, we multiply this by 100. And with this, we will get an amount, a rate of 4.8. 4.8. Okay. So with this 4.8, it is what we call the capitalization rate. So if the amount, the general borrowing is, let's say, 10,000, out of this 10,000, 4,000. So let's say that this 4,000 has been used to construct a qualifying asset. It means that in order to determine the borrowing cost in relation to this amount which is used to construct the qualifying asset, we apply the capitalization rate on this in order to determine the borrowing cost eligible for capitalization. Before we look at the commencement provision for borrowing cost, or when to commence capitalization, I want us to understand this. We've already learned about what a qualifying asset is. That is where we say that qualifying assets are assets that takes a substantial period of time for them to get ready for their intended use or sale. Is that okay? Where we set an example as maybe a construction of a building that takes a substantial longer period of time before it will get ready for or be completed for their intended use or sale. In order to determine the borrowing cost eligible for capitalization, or in order to determine the borrowing cost that will be added to the cost of the qualifying assets and recognized in the statement of financial position, one thing we have to take note is that the borrowing cost should be directly attributable to the acquisition, construction, or production of a qualifying asset. If this condition prevails, the borrowing cost associated with this should be capitalized or should be added to the cost of the qualifying asset. And other borrowing costs that are not directly attributed to the construction or acquisition of a qualifying asset, those borrowing costs should be treated as an expense in the statement of profit or loss, or recognized as an expense. Is that okay? All right. So now let's look at the commencement provision. Commencement provision simply means that when does capitalization commences? When should we begin capitalization? When should we begin adding the cost of a borrowing cost? Or when should we begin to add borrowing cost to the cost of a qualifying asset? Is that okay? Very good. So there are three different conditions or criteria that must be met before we will be able to commence capitalization. The first criteria is that expenditure for the qualifying asset are being incurred. So when the expenditure on the asset are being incurred, then we can begin capitalization. For instance, when we want to construct a building, the moment we begin to buy cement, buy other materials for the construction, that period the expenditure has been incurred, so we can begin capitalization. The second one to talk about is when borrowing costs are being incurred. That is when borrowing costs in relation to the qualifying asset are being incurred, we can begin capitalization. Where maybe the interest cost and other ancillary costs are being incurred, then we can begin capitalization. The third criteria has to do with when all activities necessary to prepare the qualifying asset for its intended use or sale is in progress. So the moment the activity is in progress, okay, we can begin capitalization. Is that okay? So when the construction is still in progress, they are putting up the building, they are doing this, they are doing that, then we can begin capitalization. We can begin to add the cost of the borrowing cost, or we can add the borrowing cost to the qualifying asset and recognize it in the financial statement or statement of financial position. Is that okay? The question we have to ask ourselves is that, or the question that people normally ask is that, when we begin to capitalize borrowing cost, the moment we begin to add the cost of the borrowing cost to the cost of the qualifying asset, is there any period that we have to suspend? Is there any period we have to stop a while before we continue? Yes, there is a period. That is where we have to look at suspension provision. Is that okay? So capitalization is suspended during an extended period in which active development is interrupted. So that is the suspension provision. Capitalization is suspended during an extended period in which active development is interrupted. So when the development of the qualifying asset is being interrupted by certain factors beyond the company's control, capitalization has to be suspended. For instance, that is during this Russia-Ukraine war, most businessmen or companies that operate in Russia and Ukraine where they are in progress, or they are in the situation of constructing or producing their qualifying assets. So during this war, if they are in activity of constructing, or they are in the process of constructing or acquiring any qualifying assets, because of this war, the development of the qualifying asset will be interrupted. So let's say that the construction of a qualifying asset, which is building, has to take maybe 3 years to complete. So they've done with the first year, and in the second year there is war in Ukraine, meaning that the development of this building will be interrupted within that second year. First year, construction is in progress. Second year, and in the second year, active development of the building is interrupted. Then the third year we continues. So third year we still continue. So what we are saying now, what we are saying is that the moment where active development of the building is interrupted, we have to suspend capitalization. We have to stop adding the borrowing cost to the cost of the qualifying asset. Meaning that if we are to calculate or capitalize borrowing cost for these 3 years, we only capitalize this and this. We will not capitalize this, because as at this period, it is an extended period in which active development of the building is interrupted. Is that okay? Very good. So after we've done with the suspension provision, let's also try to look at the cessation period. Is that okay? When to cease capitalization. So let's look at the cessation provision. That is when to cease capitalization of borrowing cost. When do we have to stop adding borrowing cost to the cost of the asset? Is that okay? So before the period in which we will be able to cease capitalization of borrowing cost is when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale is completed. So the moment we are done with the acquisition or construction of the qualifying asset, borrowing cost should be ceased from capitalization. Is that okay? So when we want to use 3 years to construct a building, so the 3 years has reached and we've done completing the construction of the building. It means that the activities necessary to prepare the building for its intended purpose has been completed. As at that point in time, after the completion, we have to cease capitalization. So after that completion, any other borrowing cost should be treated as an expense. We can't add it to the cost of the qualifying asset, because the activities necessary has been completed. And this cessation of capitalization may be seen from two different angles. One has to do with when construction of qualifying assets is completed in stages. Is that okay? So that is when let's say we are constructing the qualifying assets in two different stages. So that is, we have first stage and we have the second stage. Is that okay? The rule is saying that when the activities with regards to the first stage has been completed, then borrowing costs associated with this should be ceased. Is that okay? We have to cease capitalization, meaning that the borrowing cost from the completion portion should be treated as an expense. But the other stages which continues, okay, the second part of the stage where construction of the qualifying asset is still in progress, then borrowing costs with regards to this should be capitalized, okay, or should be added to the cost of the qualifying asset. But if the part of the stage which is completed, then we have to cease capitalization over there. The second angle has to do with when the construction of qualifying asset is completed in parts. So we have part 1 and we have part 2. Is that okay? So when the activities necessary for the construction of the qualifying asset with regards to the part 1 is completed, then the borrowing cost or capitalization of borrowing cost with regards to this part 1 should be ceased, okay. But the other part which its construction is still in progress, borrowing cost with regards to it, we should continue to capitalize. That is the meaning. So after looking at the cessation provision for capitalization of borrowing cost, let's look at the disclosure requirements as well. There are two key disclosure requirements that must be disclosed Okay, the first one has to do with the capitalization rate. Okay, and the second one has to do with the amount of borrowing costs capitalized during the period should be disclosed. So these are the two disclosure requirements under IAS 23. I think this will bring us to an end of this lesson. In our next video, we'll be taking a practice question on specific borrowings and general borrowings to solve in order to enhance our understanding on this particular standard. But I'll keep telling my viewers that the theoretical aspect of financial reporting is very important. They can ask you to list the disclosure requirements, the cessation provision, the suspension provision. So the moment you understand the theoretical aspect of this standard or financial reporting, the calculation becomes easier for you. Is that okay? So if you haven't subscribed to this channel, I will encourage you to do so. So that is it for the day. Until we meet for our next video, I think it is bye for now.